Welcome back, everybody. So we looked at planning, and we're going to have a look now in a bit more detail. Really, nothing particularly new. But anyway, the planning stages for a start are understand the entity, get the knowledge of the business. Okay, that's the first thing we've got to do before we can do anything else. The second thing we've got to do then is look at some analytical review. Have a look. Why has gross profit percentage gone up this year? Let's go and have a look at the sales price. Let's go have a look at the costs. Why have sales decreased but admin expenses increased? Let's focus on the admin. Have we got something classification-wise wrong? Okay, and so we do our analytical review. We check to see are things performing to how we thought they were going to perform. If they didn't, let's focus on it because that area is more risky. So that will help us feed into our risk assessment. Find out those risky areas. Then we can set the materiality, and we're going to have a look at materiality in more detail in a second. Then we can set the tolerable error. Okay, and again, I'm going to look at that with you in a second. Then we've basically got our audit approach. Okay, we can then document what our audit approach is going to be because we then know the risky areas, we know the additional work. And then finally, we check again after learning all about the company. Are we still independent? Do we still have the resources? And are the timings all sorted? Okay, so that's it. That's the stages we go through when doing the planning. Now, I did say to you then that we'd go through materiality in more detail, so let's make sure that we're on top of this. And remember, I just said that it's basically an amount. Okay, I'm going to go straight into this. I'm going to give you some amounts. Okay, for the income statement, the amount could be 5 to 10% of profit before tax, or it could be a half to 1% of revenue. Okay, and what we'd say here is, look, if the transaction that we're looking at is smaller than 0.5% of revenue or smaller than 5% of profit before tax, then it's not really that important, so we can ignore it. We only look at the things that are above 5% of profit before tax, above 0.5% of revenue. They are what we call material. Any non-material errors that we might have because we've missed it, we're not worried about. We're saying the accounts are materially okay. But these are only benchmarks, okay? These are not actual figures that you can use and say, yes, I follow the standard because the standard tells me this. It doesn't. They're just benchmarks. They're just kind of an idea, a suggestion. Okay, and I'll go into that in more detail. If it was a balance sheet item, such as fixed assets, then it could be something like, is it 1 to 2% of total assets? Okay, that could be your materiality. But they are just benchmarks. And the more volatile those benchmarks, maybe revenue goes up and down quite a lot, then you need to be more and more prudent and have a higher figure than those benchmarks suggest. Okay, now the reason why I've been saying that be careful about these benchmarks is that materiality judgment is needed on the auditor. It is not just 5 to 10%. You've got to think about, right, I need to make some judgment. I need to adjust these slightly. Why? Well, think about the nature of the entity. Is it in a fast-moving business? Is it a cash-based business? What are the risks of fraud? What's the ownership of the business? If it's just the manager owns it, then he's not going to defraud himself, so maybe I could lower the materiality. Okay, how is it financed? What do they have to meet certain stringent restrictions, which may mean they might try and massage the figures to meet them? Okay, in which case I would lower the materiality. Remember, if I lower the materiality, I will test more things. The more things I test, the more likely I am to get the correct opinion. Okay, but there's no need testing everything because that's just not efficient and it's not beneficial to the users. Okay, which brings me nicely to the materiality whole thing really is does it affect the user's decision? So let's imagine that you've got £1 million worth of debtors and you've got a 20p debtor that you think is wrong. Well, let it be wrong. Don't make any adjustments. Don't look at it too much because it's tiny. It would never affect the user. Wouldn't care whether debtors are £1 million and 20 pence or £1 million. So that's where it all comes from. Does it affect the user's decision? But that needs judgment. Okay, and to help us with these judgments, we think about the business, but we've also got these benchmarks to help us as well. So that's materiality. There is also something called performance materiality, which is slightly lower than normal materiality. And this is basically what you do is you try and aggregate all the non-material errors. So you might set performance materiality slightly lower. Okay, so you test more things that are below the actual materiality but above performance materiality. And then you can say, right, if I get 5 of these and add them together, they might together become actually material. So it's just keeping an aggregate of your non-material errors to make sure that your actual materiality isn't breached. What it also could be, you could also use a lower performance materiality for certain transactions or certain classes of transactions. Okay, and what sort of transactions would these be? The ones that users have a particular interest in. We do this for the users. Will it affect their decision? So again, things like director's salary, well, they are very interested in it. So even though the director's salary might be not material, we would say yes, but our performance materiality for wages, for director salaries, we are going to make lower. We are going to check this because we know users have a particular interest in it. Okay, so that's performance materiality. Finally, I said I'd have a look at tolerable error for you. And tolerable error is not really anything to do with materiality. All it is, just remember these words. It's how many mistakes am I willing to accept? And this is the important bit in my sample. We don't test everything, we test samples. And all your tolerable error is, well, how many mistakes am I willing to accept before I need to say, well, this control's not working, I need to do more testing, okay? So tolerable error, what we're willing to tolerate in our sample only. Okay, that concludes then everything to do with planning.